Intel stock is currently trading at $83.13 per share, marking an intraday gain of 0.68% as of Tuesday, April 28, 2026. This modest daily nudge actually hides a massive structural shift because just a few days ago, the market was bracing for a complete breakdown. While everyone was watching for signs of failure in the foundry business, the real surprise has been a massive institutional squeeze in server CPU supply that is almost entirely sold out Intel's 2026 inventory. This has created a situation where the reality of supply-side dominance is crashing headfirst into the expectation of a slow, multi-year recovery. If you thought this was just another cyclical bounce, you are missing the fact that NVIDIA stockholders and major institutional players are now looking at Intel as the primary provider for the hardware required to actually run the models everyone is talking about. The common belief was that Intel stock was a legacy giant gasping for air while competitors ate its lunch. But the deeper reality is that we are seeing a massive rotation. Institutional activity has spiked, with heavy hitters like BlackRock and even NVIDIA Corp itself taking substantial positions, effectively turning Intel into a critical piece of the global infrastructure puzzle. While retail traders were busy with the latest Robinhood stock trading trends, the big players were quietly accumulating shares near the $20 mark in late 2025, leading to the current 300% surge. We are seeing a historic level of volume, with intraday trading sessions frequently hitting 60% above the 3-month average. This isn't just retail enthusiasm. This is a foundational re-rating of what the company is worth in a world where computing power is the new global currency. Looking at the immediate price action, the $83 level is acting as a consolidation zone after a massive 28% single-session jump following the Q1 2026 earnings report. That report was the definitive moment where expectation failed and reality took over. Analysts were looking for a measly 1 cent per share, but Intel delivered 29 cents. Revenue came in at $13.58 billion, nearly $1 billion over the consensus. This kind of beat doesn't happen by accident. It happens when a company has spent years cutting costs and finally hits the point where operating leverage kicks in. If you are using a SoFi trading platform or checking your individual brokerage account today, you'll see that the volatility is staying high because the market is trying to figure out if this is the peak or just the base for a move toward $100. Institutional investors are particularly focused on the 18A manufacturing process. There are reports that yields have crossed the 60% mark, which is the magic number for high-volume profitability. For those of you managing a Schwab Intelligent Portfolio setup or looking for investment help through Fidelity Wealth Management, the takeaway is that Intel is no longer just a chip designer. It is becoming a viable alternative to the pure-play foundry models we see overseas. This is why the US government's multi-billion-dollar stake has ballooned in value. The geopolitical reality is that a domestic supply chain isn't just a nice-to-have anymore, it is a requirement. This has driven a massive influx into Fidelity ETFs and other semiconductor-heavy funds that were previously underweight on Intel. If you look at the daily swings, we are seeing a sellout narrative that is driving prices higher. When 2026 server supply is gone before the middle of 2026, it gives management the leverage to hike prices by 10 to 15%. This is the kind of pricing power that NVIDIA stockholders have enjoyed for years, and seeing it show up in Intel's data center and AI segment, which grew 22% year over year, is a massive catalyst. People using online investing tools or the Robinhood app are seeing the green candles, but the real story is in the order books. The demand for server CPUs to handle massive inference workloads has moved from a temporary spike to a structural necessity. I want to hear from you on this. Comment below with how many shares of Intel stock you currently hold, or if you are waiting for a pullback to the $70 range before entering. Do you think the current price reflects the actual value of their foundry business, or is this just a case of the market getting ahead of itself? The business model itself has undergone a massive internal surgery. Intel used to be a vertically integrated black box. Now, the Intel Foundry and Intel Products divisions are operating as separate entities. This transparency is what the market needed. When you look at your Fidelity Brokerage or Interactive Brokers account, you can now see the clear distinction between the client computing group, which is still the cash cow at $7.7 billion, and the foundry side, which is the high-stakes bet of the decade. The reality is that the foundry business lost money this quarter, but the losses are narrowing faster than the smart money predicted. This creates a tension where the legacy business provides the floor, while the new business provides the ceiling. Past performance usually suggested that Intel would stumble on execution, but the last 3 quarters have shown a company that is hitting its milestones with military precision. This has forced a lot of the bears to cover their positions, adding more fuel to the upward movement. While older reports highlighted market share losses to AMD, the new reports are showing that the total addressable market is growing so fast that Intel can gain revenue even if its percentage share stays flat. But it's not staying flat, it's rebounding in the data center. For those using the Fidelity mobile app or Robinhood investments to track their portfolios, the shift from a value trap to a growth story is the most important narrative change of 2026. Macroeconomic pressures are still there, of course. Interest rates and global trade tensions haven't vanished, but the semiconductor sector has proven to be incredibly resilient. In the context of online investing and self-investing, the move toward intelligent portfolios has naturally led to more capital flowing into companies with deep intellectual property and physical manufacturing assets. Unlike software companies that can be disrupted by a new algorithm, you cannot code a billion-dollar fabrication plant into existence. This physical moat is what is driving the current valuation. When you use investing sites or look for investment help, you'll notice that the conversation has shifted from can they survive to how much of the market will they control. Looking at the future outlook, there are a few key catalysts on the horizon. The Q2 2026 guidance is calling for revenue between $13.8 billion and $14.8 billion. If they hit the high end of that, we are looking at a stock that could easily test its all-time highs from the early 2000s. The risks, however, are just as real. Any delay in the 18A rollout or a sudden cooling in server demand could cause a sharp correction. This is where the tension between expectation and reality becomes critical. The market expects perfection now. If Intel delivers anything less than an A grade on its next manufacturing update, the reality will fall short of the hype, and we could see a retreat to the $65 support level. For those using Interactive Brokers Trading or the SoFi Active Investing platform, it is essential to watch the volume on the dips. In previous years, every dip was met with more selling. In 2026, every dip has been met with institutional buying. This change in behavior is the strongest signal that the bottom is firmly in the rearview mirror. Whether you are into Robinhood Crypto or Fidelity Mutual Funds, the ripple effect of Intel's resurgence is being felt across the entire tech sector. It provides a level of stability to the US tech ecosystem that has been missing for a long time. In summary, the reality of Intel's 2026 performance has completely shattered the low expectations the market held for the last few years. We went from a company that was written off as a has-been to a company that is now central to the most important infrastructure build-out in history. The gap between the $20 lows and the $83 current price is the physical manifestation of that narrative shift. We've moved from asking if they can make a chip to seeing them sell out of their entire inventory years in advance. The core insights here are clear. Institutional accumulation is at an all-time high. The foundry business is proving its technical viability, and the financial turnaround is producing real, taxable profits that far exceed analyst models. While the daily movement of 0.68% might look like a breather, it is actually the market consolidating its gains before the next major catalyst. The tension between the skeptics who are waiting for a failure and the reality of consistent execution is what is going to drive the volatility and the opportunity in the coming months. Intel has regained its seat at the table, and it's not just participating, it's starting to dictate the terms. Keep a close eye on those volume bars and the upcoming production updates because the reality of this turnaround is only just starting to be fully priced in by the broader market. The depth of this change is what separates the serious investors from the ones just following the noise on social media. Authority in this market comes from understanding that the physical limits of manufacturing are the only things that truly matter in the end, and Intel finally has its hands back on the wheel. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.